Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 11th of June. I'm Daniel Lam, your host for the podcast. I remember back in the 1990s, there were a series of books called Trading Wizards, which is a book of interviews with some of the world's most successful traders. Now, one of the chapters talked about how this hedge fund owner trains his new recruits by making them play 120 hours each of Texas Hold'em, because he believed poker has many similarities with trading, namely how circumstances may change sharply and you need to drop your preconceptions, adjust quickly, and react to them. Now, we believe there is a poker moment in Chinese equities right at this point in time. So let's look at the facts. China equity positioning has begun to fall. Now, will this continue? Well, the latest decline in positioning has come as a result of foreign investors pulling back rather than the locals pulling back. Managed futures accounts have been the most notable investor to de-risk. Now, this is an indication that a typical China positioning unwind is being played out, since such managed futures accounts are usually the first investor group to shed their longs, with domestic speculators acting last. A final capitulation usually comes around the 3-month mark. So it is very important to remember that foreign investor appetite towards China would wane as other markets return to favor. So in previous podcasts, we talked about how Chinese equities managed to outperform US ones from late March to early May because of fund rotation from the US into China. Now, the poker moment came last week in the form of the Indian election results, because India is one of the major markets where investors view as alternatives to China. Well, you can see that the Hang Seng Index last week had failed to break on the upside. In every trading day last week, there were profit taking on the intraday highs. However, after a sharp 10% intraday sell-off post-Indian election results, the Nifty index had already recovered all the losses since the elections. This is a serious vote of confidence for the Indian markets. Yes, it does take more effort in passing policies when you're in a coalition government, but it is a much taller order to resolve structural issues, as evidenced in the Chinese economy. Investors are taking this as a buying opportunity for the Indian growth story, its favorable demographics, and growing middle-class consumption thematics. So, we believe the cards have changed once again after this brief rally in Chinese equities. It is preferable to look at the safer choices in China, such as the non-financials, high dividend yielding SOEs, for exposure. For the longer-term horizon, we continue to believe Indian equities can outperform Chinese ones. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.